Someone asks you how much money you need to retire. For a moment, you pause. $1 million, maybe? That's the number people throw around all the time. It sounds comforting because it's big. It sounds reasonable because everyone has heard it before. But in reality, it's almost meaningless. $1 million means something completely different to someone who only needs $30,000 a year than it does to someone spending $80,000. The number itself isn't the answer. The spending is. And that's the surprising part. There is, in fact, a remarkably simple way to estimate how much you actually need for retirement. Not a random guess. Not a motivational slogan. A formula that has been tested against nearly a century of market history. It's called the 4% rule. Once you understand it, retirement stops feeling like a giant, mysterious mountain of money and starts becoming something you can calculate on the back of a napkin. But before we get to the math, it's worth asking one question. Where did this rule even come from? Because it wasn't invented by a finance influencer trying to sell a course. Back in 1994, financial advisor William Bengen asked a surprisingly practical question. Imagine someone retires today. They withdraw a fixed percentage of their investment portfolio during the first year, then simply increase that dollar amount every year to keep up with inflation. How much could they safely withdraw without running out of money over a 30-year retirement? Instead of relying on averages, Bengen went back through real market history, starting in 1926. He tested retirees who had the worst possible timing. People who retired just before the Great Depression. People who retired into the painful inflation of the 1970s. People who experienced decades that most investors hope never happen again. And after running every scenario he could find, one number kept surviving. About 4%. Later, researchers from Trinity University repeated the analysis using similar assumptions and reached nearly the same conclusion. That's why you'll sometimes hear people mention the Trinity Study alongside Bengen's research. Different researchers. Same core idea. So what does that actually mean? Let's strip away the financial jargon. Suppose you want to spend $40,000 every year in retirement. Not forever fixed at $40,000. $40,000 in today's purchasing power, increasing with inflation each year so your lifestyle stays the same. According to the 4% rule, you would need roughly $1 million invested on the day you retire. Why? Because 4% of $1 million is $40,000. That's it. The math is almost disappointingly simple. Take the amount you want to spend each year and multiply it by 25. That's your retirement target. Want $60,000 a year? You'll need about $1.5 million. Need only $25,000? About $625,000. The formula doesn't care what your career was. It doesn't care what car you drive. It doesn't care whether your neighbors think you're wealthy. It asks only one question. How much do you actually want your life to cost? And that single question changes everything. Because most people save for retirement backwards. They try to accumulate as much money as possible and hope it's enough. The 4% rule flips that entire way of thinking. Instead of asking, asterisk, how much money can I save? Asterisk, it asks, asterisk, how much life am I trying to buy? Asterisk, once you know that answer, the savings target becomes surprisingly clear. Now here's the part many people don't expect. The 4% figure wasn't designed to leave you with exactly $0 after 30 years. In fact, quite the opposite. Across most of the historical periods Bengen studied, retirees didn't slowly drain their portfolios to nothing. Many actually finished retirement with more money than they started with, despite withdrawing income every single year. That sounds almost impossible at first. But remember, your investments are still growing. Yes, you're taking money out. But over long periods, the stock market has historically grown faster than 4% per year, even after accounting for recessions, crashes, and recoveries. The rule wasn't designed to squeeze every last dollar from your portfolio. It was designed with a margin of safety, strong enough to survive some of the worst financial periods in modern history. Let's make this feel real. Picture someone retiring at 65. Their investment portfolio is exactly $1 million. In the first year, they withdraw $40,000. Life goes on. Groceries, utilities, travel, dinner with the grandchildren, The following year, inflation pushes prices slightly higher. So instead of taking another 40,000, they withdraw 41,200. Not because they're spending more lavishly, but because they're simply maintaining the same lifestyle. Some years the market climbs. Their investments grow faster than their withdrawals. Other years the market falls. Their balance temporarily shrinks. Yet over decades of historical data, this rhythm continued working. Money came out. Markets moved. Life continued. And in the overwhelming majority of historical scenarios, the portfolio lasted. But here's the detail that really matters. The 4% rule isn't just about withdrawing 4%. It's really about something called sequence of returns risk. The name sounds technical. The idea isn't. Imagine two retirees. Both earn exactly the same average investment return over 30 years. On paper, they should finish in exactly the same place. Except they don't. The first retiree experiences a massive market crash during the first year of retirement. The second experiences that identical crash 28 years later. Same average return. Very different outcome. Why? Because taking withdrawals while your portfolio is falling forces you to sell investments at lower prices. Those shares are gone forever. They can never participate in the recovery that comes later. That's why the order of returns matters just as much as the returns themselves. And it's exactly why Bengen tested every possible retirement year individually instead of relying on a simple historical average. Average returns can hide ugly realities. Sequence risk exposes them, which means saving enough isn't only about reaching a certain dollar amount. It's about building a portfolio that can survive bad timing. Not average timing. Bad timing. That's an important difference. Of course, no financial rule works perfectly for every person. The 4% rule has limits. It was originally built around a 30-year retirement. It relied largely on historical U.S. market data, and it assumed a diversified portfolio of stocks and bonds. Someone retiring at 45 could easily need their money to last 40 or even 50 years. That's a completely different challenge. Because of that, some researchers recommend a more conservative withdrawal rate, closer to 3% or 3.5%, for exceptionally long retirements or for people who simply want a larger margin of safety. Others take an entirely different approach. Rather than withdrawing the exact same inflation-adjusted amount every year, they allow spending to flex. When markets are doing well, they spend a little more. When markets struggle, they tighten the budget slightly. The destination stays the same. The route becomes more adaptable. That's why the 4% rule should never be treated as a law of physics. It's not a guarantee. It's a starting point. A remarkably well-tested one, but still a starting point. So here's the question worth asking yourself. Right now, how much do you actually want to spend each year once work becomes optional? Whatever number comes to mind, multiply it by 25. That's your first real retirement target. Not a number someone on television mentioned. Not a number your coworker guessed. Your number. If you want $50,000 a year, your target is about $1.25 million. Maybe that feels achievable. Maybe it feels intimidating. Either way, it's useful because uncertainty has now become arithmetic. Instead of wondering whether you're saving enough, you know exactly what you're aiming for. Every dollar you invest from this point forward has a purpose. Every contribution moves a measurable distance toward a clearly defined goal. And somehow, retirement feels a little less mysterious. Someone asked you how much money you need to retire. Not long ago, your answer might have been a shrug. Now, it's a number built around the life you actually want to live. A number grounded in decades of research. And a number that has already been tested against some of the worst markets history has ever delivered.